Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance, and on this episode, we're going to discuss precious metals market bubble, housing now a buyer's market, no tax on overtime, and a look at the Plan Solutions Incorporated office bulletin board. Mr. Armour, how are we? Good, sir?
Doing well. Yeah, getting right into tax season. It's been good. A lot of work's been coming in, which we appreciate. You know, you always get a little nervous when tax season starts and there's not enough work to keep you busy because you know it's going to come all at once, right? But so far it's working out pretty good.
Yes, sir. And I have almost all my documentation. So rolling forward here, let's dive into precious metals market bubble. This has been a really interesting market. We've discussed it here over the past few months. What have we seen? I know there was kind of a bit of a dip recently.
Yeah. And you know, really, we were writing this article when it was kind of right at that peak, where we were seeing, kind of that peak, and then we saw a bit of a pullback. Well, in some cases, pretty significant, right? So, but yeah, gold prices increased 125% since the beginning of 2024, and silver prices up a eye-popping 225% over that same time period. And those are even, after we saw that pullback, where in just days, the price of gold fell 13% and the price of silver dropped 32%, right? So, we're seeing some really strong returns in precious metals, but also just some extreme volatility in pricing, which, a lot of times is indicative of a potential bubble.
Yeah, what was kind of the trajectory for? We'll start with gold. I don't recollect us really speaking around gold or silver until late last year, really mid-late last year, if I remember correctly, as far as what we put out here on the podcast. But it's been an interesting trajectory.
Yeah, I mean, the impetus of this, which a lot of times you'll hear, one of the causes is central bank buying, right? Mm-hmm. Well, what does that mean? It means, other nations buying gold. And in many cases, buying gold and selling dollars, which is why gold has increased so much in dollar terms. And the reason for that was really the Russia invasion of Ukraine. Kind of upended some of the financial markets. And as a part of the sanctions, the U.S. Kicked Russia or key Russian banks off of the SWIFT payment network, which stands for Society for Worldwide Interbank Financial Telecommunications. It's basically how banks, settle payments across borders. And so with Russia and then, some of the other countries in its orbit, had to seek out alternative payment networks. And one of the proposals that they put together was creating their own payment network that was centered around gold, basically a currency that only these central banks or these banks would use between each other, backed by gold. And then, you had the seizure of some, Russian assets that were denominated in dollars. You just had a lot of other countries suddenly worried about holding high amounts of dollar reserves. And so they were looking around saying, well, what else could be used as a store of value? And, you have this kind of historic relic of gold, the old gold standard. So that pushed a real, increase in buying from central banks, which has caused the value of gold to increase from roughly $1,600 an ounce, before these things were announced to now over $5,000 per troy ounce.
Wow. Yeah, it's it is an interesting scenario, and I think it's Just reminiscent of what's kind of occurred in the economy over the last 5 years or so. We've had so many economic anomalies that have just come to fruition around this. So, with that said, why don't we jump into silver and then kind of dissect maybe why the dip now has happened or the bubble burst, so to speak. My words, not your words.
Yeah, so arguably silver's done well because gold has done well.
Mm.
There's often what people refer to as the gold silver ratio, which is basically, is used to value gold and silver in comparison to each other. So, when the ratio is high, when gold prices are high relative to silver prices, the strategy is to buy silver and vice versa, right? And so with gold running up for a while there, silver didn't really respond. But eventually, I think, that gold silver ratio became so extreme that it caused really heavy buying into silver. But, with the more recent run up in prices, I think it's not entirely explained by central bank buying. I think, what has started out as a logical response to this change in fundamentals or change in the geopolitical climate basically caught the attention of speculators, people who don't plan on holding the gold or silver for the long term or as reserves, but more they're seeing the price go up. So they're piling in and they're buying on the hopes that it will continue to go up. And in a lot of cases, potentially, the challenge there is, with the price, with speculators jumping in, they can push the price way up, but they're not going to be long-term holders, right? The price needs to keep going up to perpetuate this because it comes with costs. If you buy gold, I mean, you have to pay to store it, to protect it. Obviously, that's a big risk. Or if you're buying gold futures contracts where you're not necessarily holding the gold, but you're getting exposure to the price change. Typically, when there's a lot of open interest on one side, right? In this case, being what we call the long side, betting on it going up versus the short side expecting them to go down. The way the futures contracts compensate for that is you end up with what's called a negative roll yield, which means every time you roll over the contract because you don't want to actually own it to the end and have to take possession of that physical gold, you're incurring costs. And so that negative roll yield kind of offsets what you'd otherwise pay to store it or, other options. So it creates an incentive to sell if prices stagnate, much less fall, right? Because prices have to be going up to create a profit after incurring these costs. So if prices start to flatten out, suddenly the speculators are not going to be sitting on that gold. They're going to sell because they don't want to incur those costs. And then, of course, if prices start falling, it's going to create this domino effect where everybody's trying to get out because, it's just the math for the speculators no longer works.
Yeah, so it just ends up being something, just no point in holding on to it. And correct me due to my lack of knowledge, I'm not guessing this is a type of holding that comes with some sort of dividend either.
Right. That's the thing with precious metals. They don't pay dividend. Arguably, a lot of types of investing have positive implications for society, right? If you solve a problem that people have, then there's typically some return there. So whether that's a company that provides goods or services that people demand, or if you're lending money, you may be lending on different projects, or maybe, you own a piece of someone's mortgage, right? You're helping someone buy a home and build wealth that way. Gold doesn't really do that. Silver doesn't really do that, right? The money just sits there. It's a metal. It's not really being used for anything. It doesn't create any profits. It doesn't kick out any dividends. It doesn't really necessarily employ anybody, right? Or maybe it does a little more in the gold mining industry or something, but it's not doesn't have a big positive impact on the economy, which is one of the negatives of more and more value being stored in gold. That it doesn't have those positive knock-on effects. You go back to the Great Depression, they actually outlawed the private ownership of gold for that reason, because everyone was just putting their money into gold, silver, that type of thing, burying it in the backyard. Well, if that's where all the nation's value is going, right? How do you how do you pull yourself out of a depression when the investment is going into something that's not necessarily productive.
Yeah. Anything else you want to add before we jump to housing, now a buyer's market?
Well, just the right now the precious metals market. I mean, it is very volatile. It's very risky, and it may very well be a bubble. So people should be very careful, and jumping in at these high levels. The long-term risk return of precious metals has not been great. In the early '80s, we had a period of a really strong run up. Got over $800 an ounce for gold, and then went down to $250 an ounce and stayed there for 20 or 30 years. So, that's about as bad of an investment profile as you can find. But it does go through these periods of really strong returns too. So people need to be aware of both sides and what the risks are.
Absolutely. All right. Housing now a buyer's market. During COVID, we obviously saw housing unexpectedly became a strong seller's market. The demand for housing increased sharply. Of course, there was probably a lot less permits being issued, new homes being built, and so on. But we're starting to see a shift around that. Interest rates were a bit lower. We saw an increase of that. We saw, inflation that we spoke around, but the shift is starting to take place. So what are we seeing now for the shift to become a buyer's market? And it's a great question, because I even noticed in my neighborhood recently, there was houses that were on the market, new ones came on the market, and they sold much quicker. So I'm actually seeing this physically take place in front of me.
Yeah, it's interesting that it just seems that the number of homes for sale has been growing. There was a period where people weren't listing their home because they didn't want to give up their low interest rate mortgage, right? So who wants to sell and then go buy and now, give up a mortgage at 3% and have to take on a mortgage at 6%. So I think people were holding back and there just wasn't as much inventory, but finally enough time has passed that, maybe people are being forced to sell for a whole variety of reasons, right? Maybe jobs moving, maybe, someone passes away and the estate needs to be settled. Maybe people just finally saying, okay, we want to go to that retirement home, or a home that's more conducive for retirement. And we just can't wait any longer for interest rates to come down. While at the same time, the number of homes for sale have increased, while at the same time, the number of potential buyers seems to have waned. Maybe some of the survey data we're seeing on consumer confidence, things like that, making people a little hesitant since that's been weak. Interest rates are still high, so affordability is still a challenge. And so it now seems to have kind of come full circle where, during COVID, you heard about bidding wars and things like that, right? Homes selling for much more than they were listed. We're seeing the opposite now, that the Wall Street Journal reported that the average sales price in 2025 was 8% below the asking price. So that's the largest discount we've seen since 2012. And that in December, the national market had 600,000 more sellers than buyers. So again, a lot more sellers coming to the market, buyers not necessarily responding. And about 2/3 of the homes sold for less than asking. So, I think it's something interesting for people who are maybe thinking of buying to at least be paying attention to, right? There may be better negotiating power. The market may be weaker, so you may have some opportunities. And, if you're in good financial shape and can put down a good down payment and things, it might be a good time to get in before that demand recovers, where you'll have more choice of the homes that are available and, maybe avoid a bidding war, those kind of things where you end up paying more than you want to or more than you think the home is worth just to be able to, to get into a house.
Yeah. Well, and it, has the continual sign of where interest rates have gone, maybe, a helpful area too, to this point, obviously with, the amount that's out there on the market of houses, and then the demand being a little bit lower, we're pushing down the equilibrium and that median price that to your point around folks maybe being those in a good financial situation knowing and understanding there is an opportunity of refinancing potentially down the line, a year or two from the date of the purchase to, get in at that better rate, but they can weather the storm, so to speak, and it's not anything detrimental to their finances, maybe in those first couple of years.
Yeah, that would be the strategy. There's an old saying that you can write off mortgage interest, right, on a high interest rate loan, but you can't write off overpaying for a house. So, if interest rates started to come down, we could see affordability improve. We could see a lot of buyers flood back into the market, bring things more into equilibrium, or even tilt it back to being a seller's market again, where sellers have more negotiating power. So someone who has, sufficient down payment, sufficient income, it might make sense to get in before that happens, right? And so even though interest rates may be high, if it's a good opportunity to negotiate a good deal on a home, to your point, pay the higher payment, the higher interest rates for a few years. And then if we go into a recession or if we go into a period where interest rates fall, be able to refinance at that time to lower the interest rate. Whereas, housing values might be rebounding or just demonstrating a stronger trend at that point.
Yeah. All right. Well, let's dive into no tax on overtime. Individuals who receive qualified overtime compensation may be eligible to take a tax deduction on the amount of pay that exceeds their regularly hour pay rate. We have touched on this a bit. There's speculation about it, but now it's become more clear. So what are the ins and outs around this and any of the misconceptions?
Yeah, and now that we're in the middle of tax season, we're actually dealing with it, right? So there's been a lot of questions, so we thought it was a good time to revisit. The new tax bill says, okay, you get, you won't be taxed on overtime pay, but not the base rate. It's like if you're getting paid time and a half, it's the halftime, right? The extra pay that's not taxed. But there are limitations. There's certain professions that do not qualify. And then there's a maximum amount. So it's 12,500 for single filers, 25,000 for married. But also your income has to be under 150,000 if you're single, 300,000 if you're married filing joint, right? So you have to meet those requirements. For this tax season, it's a little challenging because for 2025, the Form W-2s may report the qualified overtime in box 14. In fact, I've seen quite a bit of that. So a lot of employers have been doing a good job, although they're not necessarily required to do it, right? So it's a little tricky. The other thing that I've seen where there's been some misunderstanding is how overtime is defined. So the overtime compensation, it's based on federal law, right? The IRS tax law, it conforms to the federal law. So in some states, people get overtime if they work more than 8 hours per day, right? And so they say, oh, that's overtime. Well, federal law says you get overtime when you work more than 40 hours per week. So if you work 3 days a week, 8 hours a day and you go over your shift and you get overtime, if you don't get to the 40 hours for the week, it's not actually qualifying overtime for this. So in some cases, it requires actually going back and reconciling individual pay stubs if it's not reported by the employer or if you think your employer reported the wrong amount.
Yeah. So just any kind of insight around what folks should do with that is as simple as, hey, go back, hopefully you've retained your pay stubs. If not, you should be able to ask for those and just have to manually go through and do an overall check.
Right. Yeah. I mean, the first thing is to ask the employer if their system's able to run that, right? And if their system's running it and this is what they're reporting, it's probably correct. Probably the misunderstanding is just around the different definitions of overtime between state and federal law. If the employer is not doing that, then yeah, it literally is a pay stub by pay stub, having to gather all of them and go through and reconcile it. So at that point, the question may be, how big of a benefit will this really be? Is it worth that time and effort? I think that's the thing for people to ask themselves.
Yes, sir. Absolutely. All right. Let's jump on over to the Plan Solutions Incorporated Office Bulletin Board. We got 2 items pinned up there. What is the first one, Mr. Armour?
Yeah, well, the first one was kind of a fun one. I know you've got this side project, the Magic Key podcast, which is really a Disney themed podcast for kind of super fans or maybe the casual fan that wants to learn a lot of the little detailed in and outs to make the most of a trip to Disney Park or different Disney media. Um, so yeah, the other day we had some interesting news with Disney that Bob Iger was stepping down as the CEO. He's still going to stay on the board, and they had kind of a leadership shakeup. So you emailed me and said, "Hey, can we get on the podcast and maybe talk about the business side here because people that are Disney fans might be interested in the implications and it also really fit in that." The new CEO was the one who's the head of the parks and the cruise lines and things like that. A lot of the more interactive things that people may experience. So that was a lot of fun. And of course, if people want to check it out, how would they go find that content?
Yeah, just go to YouTube and you can search Magic Key Cast, or you can simply type in youtube.com/at Magic Key Cast, and I'll even include the link in the description for this episode. But yeah, I would appreciate you guys going over and checking it out. It was a fun opportunity to take our combined passions and dig in, and it was a lot of fun. It was a lot of fun to really unpack that, and I'm sure that as more news comes out financially, maybe we'll make it something a little more frequent where I can get your time and get that real insight. And quite a few of the comments I got really appreciated having someone that it was clear knows what they're talking about, as opposed to just reading off a couple of things that they saw and repeating it. So it was a really engaging conversation. And as far as the analytics go, it had a great majority viewed time. So I think it was about 65%, which is really good for a YouTube video. So thank you for your knowledge and insight. It was a lot of fun.
Okay, so we didn't bore people, didn't bore them too much with the business talk. That's good.
No, sir. Second item you have pinned up there.
Yeah, and then the other item, just kind of the annual reminder at this time in tax season that Schwab's posted a lot of the Form 1099 Div and 1099B for non-retirement accounts. But historically, they've issued corrected 1099s in late February or early March, right? So as we're going through, if we can kind of look at them and say, it's very unlikely that this will be corrected, or if it is, it'll probably be very minor. Those returns we're comfortable with filing. If we think there may be a larger correction, we're obviously going to hold off to get that information. So it could delay the filing a little bit. We're also dealing with a number of state forms haven't been finalized as they're making adjustments based on the federal tax law changes. So there's been a number of returns we've had to sit on until those forms are finalized to make sure that nothing changes. But that doesn't mean, people can't send in what they have. If we're their financial planner and investment manager, we can get those forms online when they post. So we can get everything else done and then just, delay until everything else is final.
Awesome. Anything else you want to add before we wrap up this edition of the Plan Solutions Incorporated podcast, Chase?
Just, hope all the people in the Sacramento area staying dry, no flooding. It's been quite a storm that we've had. I know anytime we have this much rain, it makes my commute a lot longer because I got to take the long way around with all the flooding. But it's good that we're getting rain. California, that's always the water politics are probably the biggest thing in California. So it is good to get all this rain and see the snowpack.
Yes, sir. Absolutely. I live just west of Yosemite, so the mountaintops are looking beautiful right now. Well, we thank you all for listening to the Plan Solutions Incorporated podcast. Please hit that subscribe button on Apple Podcasts, Spotify if it's your first time. Leave a rating, leave a review, and please share with others as we don't do any advertising of the podcast. So your word of mouth continues to help the podcast grow. Or even go over to youtube.com/@plansolutions and you can watch along to a video version of the podcast where you'll see the personal financial review, the written content that Chase and I discuss here on screen with the audio underneath. And if you have yet to subscribe to the Personal Financial Review, it's simple. You just send Katie an email. It's KATIE at plansolutions.com and get subscribed today.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.